trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good morning, market rebels from a very chilly, or I should say freezing cold, South Florida. Stu, I can't even believe it. It shows 49 degrees right now.
That is really chilly for your neck of the woods, Bill.
It is very chilly. And I had the AC on last night when I went to sleep. It was actually hot.
And
Crazy.
you're still wearing your little Florida shirt there.
This is the thickest I have. This is my winter gear right here, man. It's got sleeves.
You need a loan to go buy a sweatshirt? I can help you out.
Oh gosh. Anyway, we're recording this early again, like we've been doing here recently. This is now going to be aired at 4 p.m. Eastern. Excuse me, 5 p.m. Eastern on Thursday. But I think at this time, for this Thursday, we're going to just be coming off stage in Miami, aren't we? I think we're on from 3 to 5.
3 to 5 on Wednesday? Thursday,
Yep.
yeah.
Yep. So by the time all of you are watching this, we're just going to be getting off stage, but we're really looking forward to it. And today's Coach's Corner is a little bit of some things we'll be talking about in Miami, limit order books and things that can go right and things that can go wrong if you don't understand limit order books. But we did it before.
You're telling me things can go wrong?
Things can go wrong if your perception, if you don't understand where prices are coming from and how fragile they can be when you realize who's putting those quotes up. But we did this fairly recently, focusing more on just the limit order book. But we did get some questions in Q&A where people were saying, all right, well, the little model that you put up there was simplified. You were assuming that everybody had the same number of shares or the same number of contracts. And I said, yeah, that's right, but that's the essence of it. And they said, well, what happens if it, like in a real world, and they're not equal? You can't just go down to that center point. We thought, good question. So let's do a little bit of a recap. So what's going to be new is we're going to make this a little bit more of a real world model of how prices are opened. So good question for people. And of course, our Chalk Talk question is going to be very direct. How is the opening price determined? This is actually what's called the opening rotation in the options market. So when the bell rings at 9:30 and you see the little, prices are starting to flicker and we're getting activity, the options still could be sitting there.
They could.
Nothing happens.
You have to hit the button. They have to hit the button.
What happens, they have to go through an opening rotation and say, well, let's see where the stock opens, reprice everything. They usually start at the money and front term of current month and near term, and then just start rolling out. Leaps come out at the end. But what they're doing is they're saying, all right, let's run it through our models and just see how things are shaping up here. So that's why if you're trading options and you see your stocks trading, the underlying, your options might not be moving yet, and that's why. So what we're going to show you is what the models are looking at to determine that opening print.
These days, it's very quick. It's almost
It's very quick.
instantaneous with the stock opening,
I
but
know.
not always. Not
No,
not
no,
always.
it used to be 10 minutes. There was a good 10
It
minutes
could
to it.
be if it was a heavy book that had a lot of
Yep.
orders, and we had to all pair them off and
Yeah.
figure out who's buying what at what price.
Yep.
Yeah, it might
Yeah.
have taken a while, and all that was done by hand.
I know. I can't even imagine that.
It was all we had,
I,
sometimes reams full of orders because they were all paper. It wasn't electronic, and had to put them,
crazy.
match them up all together, and yeah, it was quite the process.
Wow. So anyway, it's a good question. Let's go find out how this is done. So how is the opening price determined? So a lot of times you might
I
say,
know the
well,
market
you were the
maker
one
figures
doing
it
it.
out. It's those market makers again.
Exactly. But a lot of times once you see your option open, you're going to see a bid in an offer. And so it looks like they open it with a bid in an offer, but they really open it with a single price
Yeah,
called an
always
opening
there's
print.
a price. Yeah.
It's just a price, and what they're doing is clearing the market. But where is that price? How do they figure that out? So that's what we're going to do. Now, before we get into it, you know where we're going with this, marketrebellion.com/get started. Lots of great articles, videos, tutorials on topics just like this to help you get started. So the limit order book, sometimes abbreviated LOB, and in financial markets, they're all driven by what's called a limit order book. All of you know what a limit order is. I want to buy the option at a limit of 3. That just means I'm willing to pay up to 3, but no more. So you could get filled for something less, you just can't get filled for something more. If you do a sell limit at 3, you have to get a minimum of 3. You can't get anything less. That's a limit order. Now, the trade-off is you might not get filled because it's a conditional order. But everything that you see going into the books is a limit order. Well, why can't you put a limit order there? Well, you can enter a limit order, but what you're really doing, they can't put a limit order onto the books because by definition, it's guaranteed to get filled. So what you're either doing is saying, okay, I want that, I'm willing to take that bid or hit that bid, or I'm willing to lift this offer. So market orders are always just saying, I'm willing to kind of walk up on the shelf and say, yes, I want to take the other side of this one, and you're just automatically pairing yourself up. So again, a buy limit is the highest price where a trade can be executed. The sell limit is the lowest price where a trade can get executed. Now that is true whether we're talking about stocks, bonds, options, whatever you have. Same idea. If we have two trades or more that appear with the same price, which is going to be very, very common, most trades are going to congregate around the current price. When you got millions of people trading, very good chance you're going to have a lot of repeats. And what they do there is they start listing them according to price and time. Price first, called price priority, and then time priority. So let's go through, this is what we did before, just kind of a refresher for people, and then we're going to show you what actually happens with an Excel model of how the computers are going to actually pair those up. So back in the day, like say when Stu was doing this with no computers, we're going to make it simple just to follow. Most of the time you're going to have existing orders, right, from the days before. But
Bill,
let's,
one second.
yeah,
As I'm listening to you, I'm thinking to myself, there must be people out there that are wondering about their market orders. So your market orders don't apply here. Your
that's
market
right.
orders go into the market and they execute immediately on the bid or the offer or somewhere in between. That's
Correct.
it. It's done. They don't go on what's known as what we're talking about here, which is the book or the limit order book, where people just specify that they have a limit, whether buy or sell, whatever that price is, and it goes on this, used to be paper, now it's an electronic book. That's what this is. Your market orders just execute and their history.
That's right. So let's say that we get this order that comes in to buy for a limit of $3.46 for 5 contracts. Now, once again, they don't know where this came from. It could come from E-Trade, from Schwab. We have no idea who it is or where it came from. That doesn't matter. It's for this particular book. Now, when I say a book, this could be for the February 100 calls for ABC stock. Right? So we're looking at just for Microsoft. They're all going to have their own limit order books. So we know that buyers place bids. So we have to list this guy under the bid column. Why are we not moving here? There we go. So we're just going to, computer nowadays, but they're going to stack them up over here. Another order flows in, buy at a limit of 336 for 2 contracts. Another buyer. So he goes here. Now, the reason that he goes to below, the markets always want to know who is the highest bidder. That's really where the action is. That's what we're trying to determine. And because obviously anybody can say, hey, I'm willing to bid $1 for Microsoft. Well, of course you are. But we're not going to form a market around that. We want to know who is the most aggressive bidder. So the 346 goes on top. And so we're just going to keep going. Now, also notice we're not doing any, we couldn't care less about the numbers of contracts. All right. Now, there are some methodologies that will, but most of them are going to use something like this. So now a sell order comes in at 308 for 2. Sellers place offers or asking prices. So this person gets stacked up over here. Another one comes in, sell at 322 for 10 contracts. So 322, this is a seller. So he's got to go under the offer, but why would he go below 308? I just said that bigger numbers were better. Well, bigger numbers are better for bidders, lower numbers are better for sellers. So the same thing, you could say, I'm willing to sell my Microsoft shares for 1,000. I'm sure you are, but not happening right now. And so the market's saying, all right, who's the most aggressive bidder, but who's also, let's call it the most aggressive seller?
Lower in terms of getting it filled.
Getting it filled, right?
What's the best offer?
Exactly, right. So
Best
we
bid.
would
And then,
typically, right. But that can be confusing because sometimes people say, well, let's see, this one's the best and this one's the best. No, we're talking about best in terms of being a seller, in which
a
case it's
seller
the
and a
lowest,
buyer, yeah.
right?
And there's actually a term for this. It's called NBBO, National Best Bid or Offer.
Best bid or offer.
And the exchanges themselves actually have rules around
That's right.
national best bid and offer to protect public order flow.
That's right.
They're called trade throughs, which aren't really allowed to happen. Every once in a while, they do
Every
happen.
once in a while they slip through, yeah.
Yeah.
So another guy comes in here, buy 342 for 7. Now he's going to get wedged in between. Why is that? Well, you should be able to figure it out. 346 is still the highest number. So he's not as strong as 346, but he's stronger than 336. So you can see what's happening. We're just, and the way that I have this set up, we're lining them up in descending order, highest price first, and then we're just going down the line. So that's all that's happening here. The right side, the sellers, is going to be the opposite. So another order comes in to sell at 316 for 1. He's going to go in the middle. Again, 308 is still the lowest or the best for the sellers. 316 would be the next. 322 is the next. So this process just continues. 350. Where's this guy going to go, Stu?
Which one?
350.
Oh, the 350 guy. He's going to go to the top of the barrel, dude. He's best bid.
He's best bid. And everyone in here can do that too, which is why it's wrong when people say, oh, this is the market maker's quote. If you are the highest bid, the quote that you're seeing on your screen is you.
If it's you, it might be a market maker. It
it
might be an institutional order. It might be anything. It's just the highest bid.
Right. But if you are certainly free to put that up, the markets always want to know who is willing to pay the most.
Yeah.
So sell for 302. So again, let's say that this is your current asking price on your platform. And you say, well, let me sell at a limit of 302. And what'll happen, I should say, if the markets aren't open yet, to clarify that, because that would be Phil, it'd be a marketable limit. But anyway, the point is, on the limit order book, you're going to go to the front of the line because you are now the lowest offer. Again, the markets want to know who's the highest on this side, who's the lowest on this side. All right, so this process continues. Now, what is time priority? This is price priority. Time just means if we get matching numbers, which again is going to be pretty common, we're going to sort them. We're going to do another sort of time. So let's say another guy comes in here to buy at 346 at 3. We go, oh, we already have a 346. Is it fair to put this guy on top here? No, because this guy was here first. So even though they have the same number, we have to list them according to time. So what the markets are going to do, or the computers, they'll look and say, all right, well, we have 346 is the number, not the same trader, but it's the same number. So let's put it on our book here as 346 for 8, you got 5 and 3. So that's why this is wrong if people say somebody has a bid for 8. You don't know that. It's most likely it's a combination of lots of people underneath there. And then what the computers will do is they'll stack these then according to time. So if a trade comes through where we can get 346, this person's going to get filled before this person because their order was there. Okay, so it's always just working from the top down.
Bill, we should mention that there are, I think it's up to 18 different exchanges these days.
Unbelievable.
Yeah.
I know.
And each exchange is kind of going through this with their own books.
That's right.
And each exchange's books need to somehow in the big marketplace pair up with one another
That's right.
so they don't create these trade what we call trade throughs. Like you can't have a 350 bid on the SIBO and a 325 offer on the PhilX, right?
Right.
That's not going to work.
Those should cross, correct.
Right. I mean, somebody will try and step in and pick them off at 3.25 and sell them at 350. But the thing is that when you're looking at the quote on that you're seeing on your matrix, it is a combination of all the exchanges, all the books, NBBO, National Best Bidder Offer. Behind that is the level 2, where you can look at which exchange is bidding for how many.
Right.
And on some platforms, you can actually see who's making up, how many are making up each quote, underneath the best bidder offer.
Yep. And that can be helpful if you're about to put in a really big order. It'll
Yeah.
give you a sense of some of the depth back there, which is
Yeah.
why they sometimes call them, it's a level 2 book, but like E-Trade calls it depth view. And that's why, because you're seeing
Yeah,
how
they do.
deep are these quotes. Yep.
Yeah. And
So,
there's finagling around that too. I mean, you see a bid for 3,000 sitting on the book. I don't know who in their great mind would put a 3,000 lot sitting on the book, get ready to get picked up. But people, if you see something like that, people lean on that, right? They can lean on that. Maybe they step in front of it by a penny, looking
yep,
to stop themselves out. If it does, if the stock ticks down or up, depending on if
that's
it's a
right.
call or put. But there's some monkey business going on there, but it's not really. It can, and that can come from anywhere. It can come
Sure.
from an order that's like off the coast of Japan somewhere. I mean, it doesn't. It's not anything. It's just
Yep.
playing with the smoke and mirrors of the book.
Yep. Hard to believe that all of that gets filtered into 2 quotes right there.
Yeah, yeah.
Pretty amazing. So now let's go back and answer the question, who determines the price? So prices are determined by the market, not the market maker. We still hear this in Q&A. Well, the market maker is bidding that, well, maybe, maybe not. But even if it is, they're saying, well, the market maker, the options trading at 3, the market maker could just open them at 5. Well, no, the market maker would have no incentive to do that within limits. We're going to talk about that here in a minute. But for the most part, it's this book. That's what's determining the net price. So market makers balance the supply and the demand. That's really what they're trying to do.
And also, everyone, keep in mind that a price, and for lack of a better term here, Bill and you and I have been kind of talking about this lately. A fair value price, as determined by the market, may have nothing to do with the orders that Bill's putting up there, that 302 offer and the 350 bid.
Yep.
The fair value price might be, like you just said, it might be $5 because the stock
Under
is
that definition of fair value, correct? You're saying the
gapped
market's
up, and now the stock's not 102 anymore. Now it's 105. So now the price on the option is now $5.
right.
And in that, if that was the case, then none of those bids, that 350 on down, would get filled. They're just sitting on the book. They're
Just sitting
left
on the book.
in the dust, and
Called
all of
resting
the
limit orders.
offers are getting filled. And if they come out at 5, they're all getting filled at 5.
That's right.
And the market may come out 5 bid.
That's
It
right.
might.
Yep, all interesting stuff. So the point is that there's a small group of traders responsible for the price, which are called the marginal pairs. And this is the level where we reach the first failed cross. This is an easy way to kind of visualize where we're going to figure out where these pairs live. So when we talk about a failed cross, we're talking about crossing these orders, or in other words, matching them up. That's going to be where the bid is less than or equal to the offer. So let's say here's our completed book right now. It would still be very small by today's terms, but just to follow along, we look through here. Now remember, we've got the highest bid here in descending order. Over here, the lowest offer in ascending order. So the computer's just going to look left to right. Is 350 greater than 302? Yes, cross them off. Is 346 greater than 348? Yes, cross them off. 342, 316, 336, 22. We've got 30 to 28. See, we're getting closer. That's the point. We're starting to get closer. And then we hit 324, 334. Not true anymore. 324 is less than the offer. So what we do is we say, that's our first failed cross. And this is what? The last that cleared. And those four traders, and who are they? We have no idea. Like Stu said, it could be coming from Japan. We have no idea where they're coming from.
Yep, it doesn't matter.
And it doesn't matter. We're just saying, here's our best bid, best offer. So it's these four quotes that are really responsible for creating the market price. And this is why it's wrong when they say, oh, the market maker is just going to take it up to 5. No, not true. Or he's going to open up at 1 and make everybody scared to sell, and then he's going to buy it, and he's going to take the price up to.
No.
That's the most ridiculous thing ever.
Absurd.
Because, I mean, think about it. If Stu could do that, he'd say, all right, let me put it down at 1. I'm going to make everybody fearful and sell. I'm going to buy all these contracts at 1. I'm now going to put it up to 10. I'm going to flip them at 10. It wouldn't take long before he could just absorb every single US dollar that's floating around in existence. That would be way too good to be true. He would be wealthier than Warren Buffett on the first trading day. You're going that.
And let me tell you something, everyone. That is not conjecture. I have actually tried to do that. Not to that extent, of course, but it doesn't work. Right? The market is a very competitive marketplace.
Extremely.
And when we talk about the market, it's market forces. It's people really these days. It's a global concern all over the world. Algobots, all kinds of order flow coming in at prices that particular firm or individual may feel that is their fair value. And that's what's coming into the market, creating the market. The market makers, the guys and the ladies, the traders that are streaming these quotes, they are facilitating the order flow. They may or may not join in on those markets.
Correct.
And they may choose to hit bids or take offers as the stock commands different prices. But this is where it's emanating from. It's the market coming together to create a pair off of best bid and best offer.
Yeah. So when you're looking at your quote, again, like E-Trade, Thinkorswim, a lot of brokers do it, and you could actually see which exchanges they're coming from. You can look at the individual orders, or you can aggregate them. But that's a level 2 book. And I remember back in the day, there used to be a big marketing buzz. Open an account with at least 25,000. We'll give you access to level 2. And everybody thought, oh my God, this is the smoking gun. I'm going to make all the money in the world. It's not going to do a single thing for you.
No.
What are you going to do with this 350 down here? What do you?
It doesn't really matter where it's coming from.
It doesn't matter where it's coming from. Now there's a thing called a level 3, which is what Stu would be doing, which is a computer system that allows you to come in here and actually change these. Now remember, as a retail trader, you can change that, right? If our quote right now is 324.34, you could come in at 330, and that number is going to go 330.
Unless it trades, but
unless it trades, right? But you can certainly step in there and be the best bidder, best offer. So the point being is that it's the combination. We know it's got to be somewhere between here, but we can tighten up this range because we have to make sure that these clear. Right, that's the point. This is a 330 is greater than 328, so we have to make sure these get off the book. So the way that I've drawn this here, what would be the opening print? All right. We're going to have Um, those are all the ones that cleared. So 329. Now notice it's not a bid and offer yet. That's just an opening price, and what that does is it says at 329, is this guy willing to buy at 329 if he's willing to bid 350? Of course. Same here, same here, same here. This guy's getting a little better deal. I was willing to pay 330, I got 329. All of these will fill. Now this guy's not. He said I'm only willing to pay 324, price is 329. He's not going to get filled. The sellers, I'm willing to let it go for 302. Wow, I got 329. Yeah, get him off the books. Same here, same here. This side, I got a little
Yeah.
better. Willing to sell at 328. I got 329. So you see the logic in there. So we know that all of those. Oops, sorry.
And there's nothing that dictates that it has to be 329.
No,
It could be 330, it could be 328. But it has to be somewhere in there. And that price is generally going to be determined by the rest of the world's markets as well.
that's right. That's right. So let's go to an Excel spreadsheet, and we're going to take a look at some models here. Now, what we were talking about on that previous screen is this. And if we were to plot that, we get these nice, perfect supply and demand lines, which is why it's usually taught this way. But what are we doing here? Let's say that these are the prices, 95, 96, 97, and so on. Let's say these are shares of stock. This guy comes in to buy 100 shares at a price of 95. That's a limit order. This guy's willing to sell 100. All right. This guy says, I'm willing to go at 96. So what we're going to do to figure out the opening price, over here, we're going to say, what is the total number of buyers if the price is 95? Well, if the price is 95, is that guy willing to buy? Yeah, his limit's 95. What about this? I'm willing to pay 96, but from my perspective, it's on sale. Yeah, I'll certainly take 95. Same with this guy, right? I'm willing to take 95. Everybody clears. So that entire column right there would go, and that sums up to 1,100 total buyers. That's what it means to be total buyers. What about the sellers? Well, at a price of 95, yeah, I'm willing to let it go at 95. That's my limit. What about this one here? Nope, I'm willing to let it go at 96, 97. None of these down here fill. So we just have 100 to sell. So now let's look at the net, the number of sells minus the buys. We are
This is
short.
where it gets interesting, everyone.
This is where it gets interesting. We
Yes.
would short, if Stu opened the book here, he would be short 1,000 shares that he would have to make up, right? Because we know there's 1,100 buyers, but only 100 sellers. He would have to take the short side of 1,000 shares.
If we open it at that price.
If you open it at that price. Now, so that same logic goes all the way down here. And so what they would most of the time do is to say, look, we're not here to take a lean to the positive or negative side, bullish or bearish. So in this model, they would open it at 100. Now, the reason that becomes easy is that it's perfectly symmetrical. Everybody's for the same number of contracts or the same number of shares. So if we plot this, here's the total buyers, that's the green line. So what we're saying is if the price is high, move over here, right where we touch, we look, we say, I'm not going to get a very big volume. If the price is low, down here at 96, I get a very big volume. So that's why it's downward sloping. Buyers like lower prices. They respond better to them. The red line is what? These are sellers. They respond better to higher prices. So if the price is down here, let's say at 98, Stu says, well, I can get 400 for a volume here, but if I open it at 104, I can get 1,000. And so what they would like to do is to find the point where we can match a buyer with every seller with every buyer. There's nobody unmatched.
And by the way, side note, the name of one of the names of the game here is to fill the order flow.
Is to fill the order flow, right?
There is a huge incentive for the floor, for the trading concern, for the
absolutely right
to fill the order flow. There is a finite number of contracts that are traded,
yeah.
and all the different exchanges are vying for the order flow because that's how they make money,
Yep.
right? They make money when things get traded. They don't really make money when things don't get traded.
Right.
So it's a huge competitive force to get these things done, to get them traded. Where can we get the most contracts done at whatever price it is relative to the market that's going on at the time?
Right. So that's like Stu said, that's really the key. We're trying to balance the market. So think of it like a point spread in a football game. If you're a bookie and you say, if I do no points, just a straight up bet, team A, I've got 1,000 people that want to bet on A and nobody on B. Well, how much are you going to make on that deal? You can't get a single bet matched. You don't want to take the other side of those. You're not in the business of putting yourself at risk. You're
Right?
just trying to pair off the market. So you say, all right, well, what about a 3 point spread? Well,
Change the
now
point
some
spread.
people jump from A to B. And we're looking, still not enough. What about 4 points, 5 points, 6 points? And pretty soon we find a place where I can go, you know what? I've got about 500 buyers here and 500 sellers here, or for A and B.
And that's why the point spreads change on the football
That's
games
why
or
they
the
change all the time and
baseball,
change while
whatever it is, because there's too much on one side.
too
There's too
much on
much
one
on the
side.
buy side or the sell side. So they change the point spread. The
Yep.
the Vegas odds, now it's a bunch of different places, right? They change the point spread moves to accommodate the market.
And for exactly the same reason, that's why one of the reasons that your quotes are moving, market makers or participants are going, hey, look, we're starting to get a little stacked on this side. If we maybe bring this price up, we can start matching people.
Let's tick the vol up a little bit.
Tick
See what
or
happens.
tick the vol up, right? There's all of accelerating and braking systems that they have. But at any rate, what we were trying to show here when we did this the first time is that we had people saying, yeah, but you were also assuming they're the same number of shares. And that's why you get these nice, neat X's and you get a perfect balancing point that's exactly at right there in the center. So why would you go through this whole problem when you can just pick the center price? Very good question. This is just to help you understand the concept. But let's answer the question now. In the real world, what if they're not balanced? So I've created this little model here where this is the maximum number of shares. So I'm going to put 500. So it's going to pick a random number from somewhere between 0 and 500. So now you can see we don't have the same numbers. I'm trying to keep them nice and round numbers and 100 share lots. But we have a guy at 95 who says, I'm willing to buy 300 shares. And at a price of 95, I see an order for 100 shares. I'm willing to sell 100 at 95. And if the price is 96, I can get 500, all of these different prices. So what are the total buys that we have? It's the same logic before. We have 2,900. In other words, if I open the market at 95, this guy says, yep, I'm a buyer. I'm definitely a buyer. All of these are buyers.
I'm willing to pay 105. I'm definitely a buyer at
I'm
105.
definitely, I'm going to be lucky to say,
I
man,
mean,
it's cool. I got,
at 95. Yeah.
so there's 2,900 buys, and then we could do the same thing here, but it would just be those. All right. And so we come down, we've got 2,600 and so on. What if we open the market at 105? Can we get a fill? Yeah, we have one guy for 200, or some orders, a total of 200 shares at 105, but none of these are willing to buy. That's why that's
No.
only 200.
Yeah.
Now the sell is the opposite. It's exactly what we just did, but just for the argument here, if the price is 95, yeah, you're just meeting my price, I'll sell. But this guy says, nope, I need 96 or more. So none of these people are going to be in the fill. That's why that's 100. It's just that order right there. Down here, 3,400 is the entire list. Now notice this time we don't get, I think it was 1,100 and 1,100. We don't get balanced numbers out here. They're all over the place. So now it just becomes the exact idea that we did, but it's weighted by the number of contracts or the number of shares. So we're going to say, all right, if we open the market up at 95, we're going to be short 2,800 shares. Do we want to take a 2,800 share lean like this, Stu?
Maybe. Maybe not.
Maybe, but maybe not. Because again, what we would like to do in most cases is just clear the market. And so we can look and see that's starting to get narrower. We can take a we'd only be short. I've got 1,600 buyers here, 1,400 sellers. We would have to be short 200 shares to get that market to balance there.
You know,
But then,
it's funny. Like, look at the pricing here, everyone. So if somebody was going to fill the void
mhm,
at 2,800, where what price are they selling it? What price would they be selling it at? 95. Well, if you look at the range of prices in this example, 95 to 105, do I want to fill the void at 895, or would I rather fill the void like, higher? Well, so I might step away, or the market participants could step
right,
away from that 95 price. And that's what's going on here, right? You're just kind of ticking it up higher to find an optimal price where buyers and sellers can come together and have a good time.
yep. So now you can see we don't get a zero like we did last time. We can't just look at the middle and say that's the opening price, that's the X, because it means that the market maker who's going to determine this opening print either has to say I'm willing to open it being short 200 or long 500. And depending on what's happening in the markets, that might be the case. So think of silver, SLV. People say, how come it keeps gapping up every day? This is a very good reason. If we end up with the market maker might say, you know what, I'm willing to take a long position here at 1100 and go at 101. Now, again, most of the time they're going to try to clear it. I'm just making the point that this is a very good reason why we can't always get that exact zero crossing point.
And
So
this, when we're using shares here, I mean, this is it's the same exact thing
it's
with
a,
the
it's
contract.
identical idea. Just put the word
Your
contract.
contracts are going to jump around with the share price as well,
Exactly
and
right.
with other factors.
Right.
So when you're offering, like, you bought them at, I don't know, $3, and you have an offer out there at 4 or 5, say 6, right, to double your money. So you might get filled at 8, and you might think, wow, these guys are idiots. They filled me at 8. No,
Feel me?
that's the
That's
market price at the
market
time.
at the time.
At the
Right.
time, right?
Or
Or
I
you
put a
might,
bid below and then I say, oh, I got a better fill. Well, it's probably because the market moved against you. Right. It doesn't mean that you're a trading genius that you got a better fill. It's
yeah,
just
it's actually opposite of of what you think. You
what a
didn't
lot
buy
of people
anything
think.
at a discount. What you
No,
bought is you bought at a lower price
the stock went or
because
the
the
vol.
underlying, if these are calls, because the underlying is lower. And when you keep
Right.
that conversation going in your head, you're betting for the stock to be going up, and it's actually going down. You think you're getting an advantage. You're actually behind the 8 ball
You're
because the
behind the eight
stock's
ball.
not going in your direction. You didn't buy anything at a discount. You're getting run over
Right.
as the stock is going down. Now it might turn around and go back up. That's another discussion.
Whole nother
But
discussion.
but it's not a discount. It's a value at a lower price on the
The
underlying.
the value was lower, and that's why a lot of times we use that word value because it could be the stock, could also be volatility,
Could be.
right?
Yeah.
That's why for same contract they've got the same time, but those are going to be your two drivers are the price
We
and the
we see
vol.
we see that a lot on earnings releases
Oh
where
yeah, very good.
the vol was 90 the night before, and now it's 30.
Yeah, you might say, but wait a minute, that's not right because the stock didn't move that much. Well, yeah, but vol went from 80 to 20. That's another way of saying the value is lower. So at any rate, the point that we wanted to show is now we don't get those nice straight lines anymore, right? Get
Hmm.
this, looks like a crooked treasure map here of something, but the intersection is still where we would like to clear. Now, if I hit F9 on here, see, we get more. Now, I can also do, for whatever reason, if we wanted to do uh, 1,000 shares is maximum. It's still this, it's always the same idea. And it's just going to go through and do those calculations that we did. And so let's say that this is the book that Stu's running and it's done by computer. And we'll change it here at 2,000. The computer does all the work and he comes in, he says, do I want to open up the market being short 1,000 or up 400? That's pretty much the decision.
Yeah.
And that's why the opening rotations are fairly quick these days, but that's what they're doing.
And you may not be filled on your entire order as well.
That's called a right, that's called a partial fill.
You might get a partial.
Yep.
So just because an option trades at a level, it doesn't necessarily entitle you to be filled on your entire order.
Exactly. Let's
If it
talk about
trades through your level, you are entitled, but if it
right. Let's
trades
talk
at
about
your
that.
level, you are not
Let's talk
entitled.
about that real quick. Let's say this is our uh, our quotes. Now remember what Stu is saying. Just because you see a bid of 350 doesn't mean you can sell every single contract that you would love to just because the number's 350.
It
The
is not
depth
an unlimited
there's
number. It's a
four.
fixed
It's
number.
like eBay. They're saying there's one for sale, there's four for sale.
Yeah,
That's how many you can buy or sell.
great example.
So now let's say that somebody comes in and says, I want to do sell 5 contracts. Well, if a market maker doesn't step in, the computer's going to go, well, I can get you four for 350, and then
Mhm.
I can get you one at 346, and then this
Yeah,
guy's going to get a
partial.
confirmation from his broker, partial fill, one
Yeah,
contract,
that
and
one
you
makes
now have
four.
an open order for four.
And what's the new market coming out, everyone? It's 346 bid. It's not 350 bid.
It's right, it's exactly right. Now, in that case, almost 100% of the time, market makers, it's one contract to fill the guy for five. We're just saying if it doesn't, that this is where those are coming from. If you've ever
Yeah,
seen a partial fill,
might it may be and if that guy has that true 350 limit, the market coming out might be. See, there's so many mights going on
I
here.
know,
The
I know.
market might be 346 at 350.
That's right.
Right? It could be at 350. So now the market went from 350 to something else. This is during the day, 350, maybe 350, 352, and now it's 346, 350, and you're
Yep.
sitting out there at 352 because you thought you should get it, or you're actually going in between the 350 and the
Thing I should be filled, right?
346 to be a buyer at 348 because that's the midpoint because somebody told you should get filled at the midpoint. Um, but the market outside of the one lot is really 346, 354, and you're trying to bid 348.
Right.
And you're not even really bidding at the midpoint, although it kind of looks like the midpoint
Looks
because
like,
there's
yeah.
that one lot there.
Yep. All good stuff. So anyway, we hope that gives you a little bit more of some insights into the market madness when you see these prices ticking around all the time. It is not just a market maker going, I'm the puppeteer. Oh, let me just change these. It's limit orders hitting the books.
Yeah,
High
one
bid
final
goes to the
thought,
top.
Bill.
Low offer
One
goes to the top. Who's
one
willing to
one
take them?
one final thought as well. The markets are very, very liquid these days. They're very
Yep.
computer algorithm driven models that are creating these markets. It's not some clown behind some post somewhere, saying,
Nope.
"Oh, I'll sell them at 5." I mean, back in the day it might have been, but these days the the money the money
Right.
that's making these markets is very, very liquid, deep, sophisticated money. It's firms like Goldman Sachs,
Sure.
Peak Six, Susquehanna, Bank of
JPM,
America. I
yeah,
mean,
BOA.
it's a lot of money creating, that's being driven from algorithms that each firm, is trading, each firm creates that now their trading desk uses. It's not a bunch of idiots, sitting around a desk saying, "Oh, we'll sell them at $5." That's not the case.
Exactly. So again, we hope that helps you to again understand a little bit of the method to the madness. So now the chalk talk question: how is the opening price determined? Now you can see there's lots of ways to answer it, but it's the marginal pairs, which is going to probably get us pretty close. But
Yeah,
technically, we can take what we might call an exchange lean. This is
yeah,
where I said
could
Stu
be.
might say, I'm willing to take a little 1,000 shares short or
Yeah.
500 long. So it's really this combination of things. But for the most part, it's the market and the marginal pairs that are saying this is the
For
level
for
where
the
we're
most
going to trade.
part, and that way you might come in just to facilitate the order to just get it done and move on, just to
Just to get it done and
get
move
some
on.
volume on the tape because
Yep,
after all, volume begets volume, and we like to see volume. That's what
that's
gives
right.
us as retail people really the opportunity to be market takers and not market makers.
Very well said. So anyway, we hope that helps. And Stu, I think you're flying down out of the super freezing cold into the very, very cold down here tomorrow.
I
And then
am.
we're going to be heading down to, we're actually at 51 now. We're ticking up here quickly. So we're going to head down to Miami on Thursday. We're looking forward to a phenomenal
Yeah.
presentation. We're on for 2 hours Thursday, 2 hours Friday. So if you haven't gotten your virtual pass yet, you can do that by contacting your rep with Market Rebellion.
Well, remember,
And
Bill, people are not going to be seeing this until Thursday after we do our first one.
oh, that is true. I suppose that is
Yeah.
absolutely true.
Yeah.
So we hope. Let's say that we'll rephrase that then. We hope that you've gotten your virtual pass,
Yes, we have.
and if or maybe going to be seeing us live. But anyway, more more food for thought for all of you options traders out there. We hope that helped, and we hope that you are much warmer by the end of the day. We're ticking up here as well, Stu. But we're looking forward to seeing you tomorrow and in Miami soon. We'll see the rest of you next Thursday for Coach's Corner.